Brent, thank you so much for joining us. I'm super excited. I wanted to talk about, tax strategies for small businesses, and of course, I thought of you. And so,
Very happy to be here.
thank you for being here. It means a lot.
Yeah,
Uh,
yeah,
can you just introduce yourself? Tell us who you are, what you do?
yeah. Happy to. So I'm Brent Bement. I am a CPA, and I've been doing this. It's about 17 years, and I own my own CPA firm called Bement and Company. I've got a wife and 5 kids, and if I'm not with them, I'm usually working on tax strategies with clients and doing investing on my own. We do a lot of real estate investing, and we like to apply the strategies that I'm teaching clients. But it's just fun. It's fun to see the tax savings that we can help save our investor clients, our business owner clients, or just anyone in general just looking to save on taxes. It's fun.
I see that in you too. Like you can tell, you look at it as a challenge, and how do you do it, and how do you work with people and get. I mean, it's
Yeah.
just awesome. So
When I started, like, it's just there's never one answer that works for everybody. Like everyone's in a different situation. They have different likes and dislikes and what they're comfortable with or what their level of knowledge is. But it's just, yeah, it's fun to apply all these just crazy complex laws and simplify it and break it down for people.
let me start with the question of, like, sometimes when people think of tax savings and tax strategies or whatever, sometimes they think of it as a bad thing. Is it a bad thing, or tell me about that?
I've had a few clients with those exact words where we go, okay, well, you're going to save X, or if you do this, you'll save this. And we've had people that just feel bad about it. Like, no, we don't. We want to, it's our duty to pay taxes. And I go, you're right. It is your duty to pay taxes. We all need to pay our taxes that we legally owe, and not a cent more. We don't need to pay more taxes than what we actually owe. So my thinking of it, and the way we do strategies with clients, we like to break down the tax law. We look at it a little differently and view it as a list of incentives and more of something that you need to navigate through rather than just a set of rules. It just completely changes your thinking of it. So I would never want people to think that paying taxes or reducing your taxes is a bad thing, as long as you're doing it legally. But if you do it legally, you follow the tax law, I would never want people to think that it's a bad thing.
So you work with a lot of small businesses. What
Yeah.
what do you see kind of going on right now in the CPA world with small businesses?
Well, it's been obviously a really weird couple of years since the pandemic. So I'd say if 2019 was a normal year, and I compare that to what happened in 2020, like most of the small businesses we worked with, and I'll say it's not like, while they might have saved more taxes with us, it's not just because of us, because of this, but we saw more cash going into businesses. We saw like the majority of the businesses did better through COVID that we were working with compared to pre-pandemic. And then, so say these businesses in 2020 that did really well, they had a lot of cash, and that goes into 2021. 2021 was also a really good year that we saw. They were using up the cash, they were making those investments. But 2022, in my opinion, it started to get a little weird. And I think a lot of us are feeling it, the stresses of the inflation. It really, specifically with our clients, it's the inflation has impacted the cost of their materials and supplies, like our construction companies, our restaurants. They're paying more for their food, so they're raising the prices. And then the other thing is the cost of their labor. So I'd say those are the two biggest issues we're seeing with clients right now, is the cost of their supplies and materials and the cost of their labor. And just getting people to work, incentivizing them to work, and keeping people on long term. I think the labor side of things has been really stressful for our clients. But as of right now, I'd say it's still good, as in terms of like their maybe not growth, but their kind of just ongoing profit is good, and it's continuing. We haven't seen anything really take a downturn yet, thankfully.
Well, and that echoes a lot of what I'm hearing different business owners say, depending on the industry. So
Yeah.
I agree from my side. And so, what are some things that small business owners can kind of take advantage of right now?
Yeah, right now, like, the opportunities out there haven't changed. And right now, of course, I'm focused on the tax sides of more on the tax side of the opportunities, but I'd say make sure that all your clients or business owners in general, make sure that you're structured correctly. And by structure, I mean like your business entities, your LLCs, if you have corporations, just make sure you understand that. Really, the first step of that is getting the knowledge. I like to start with the business entity structure because that's normally where we see the biggest jump in tax savings, just the way that your business is structured. So do that, and then watch for a lot of these credits. Like there are some carryover credits from COVID or from the pandemic in 2020. There were a ton of tax law changes. One specifically is called the ERC credit. It's not going to run out anytime soon. It's built into the tax law. But if you had employees in 2020 and 2021, make sure that you're looking at the ERC credit as a possibility to get some cash back, really in like the form of a payroll tax reimbursement. But that's a big opportunity right now. And then just make sure you understand, even if it was a list of other credits, like of opportunities that are out there. And the way a credit works is that, say with this work opportunity credit, say you pay someone $10,000 in a year to work for your business, there's credits that can give you back a portion of that. Like that one specifically, it's about half of what you pay them you could get back. So they keep the 10 grand they got because you paid them, but then you're getting reimbursed for about half of it. And you get a deduction on top of it. So watch for credits. I'd say, so structure your entities, make sure you got that, and watch for credits. And another one, just to take advantage of this, when we're strategizing with people and business owners mostly, we want you to understand like where you're at with your tax brackets. Like I think everyone has heard the term tax bracket, and it is a pretty common misunderstanding of the way that tax brackets work. So there's like the United States, we have a tiered tax bracket system. So all of our low income, every single one of us is taxed in like a 10 or 12% bracket. And as our income gets higher, we start getting into the 20% range, then the 30% range, and almost a 40% range. So if you think of someone that say they've got $1 million of income, they're going to pay throughout all those ranges, and all their income on the higher end will be close to 40%. But then think of like that person. This is called the tax bracket strategy and planning. That person, we want to think about what available tax brackets they have like at their disposal, if we want to call it that. What other tax brackets in their life can they use? And it's kind of a different way of thinking of it, but other tax brackets they can use could include like a corporation, which has a lower tax bracket, or could also include using their kids or elderly parents. Like they would likely have lower tax brackets, and sometimes they could be in a 0% tax bracket. So what you can do there, the example I gave, say the business owner with $1 million of income at a close to 40% tax bracket at their top income. If they start shifting some of that income legally to kids or parents or another corporation, all of a sudden the kids could be paying into 0% bracket, say on 10 grand, where the parent would have been paying 40% of that. So like on paying one kid $10,000 could save the business owner $4,000 of tax. Or if you have a corporation at a tax rate that's half of what the business owner's tax rate is, say the corporation, they're at 21% and the business owner's at 40. If you shift a couple $100,000 of income to your corporation, you'd save 40% of the like $200,000 on that. And the way I'm explaining this, I like to make it sound like it is really easy, more just simple. Like, but I want to stress that you've got to do it right, and you're not just sending money to a kid. You're not just sending money to a corporation. There's got to be reasons for it, and business reasons, like getting your kids involved and having a reason for the corporation to be set up. It's not just throwing money around and seeing where it sticks and hoping for the best. Like it's part of a bigger strategy and a bigger plan to move money around like that. But just to open people's eyes about tax bracket planning. That's really one of my favorite things to do.
Okay.
And then the other one, I like to make sure that business owners understand how depreciation works. And this is like, say a business owner needs to go buy a tractor, and it's $100,000 tractor. Right now, there's something called bonus depreciation. And what bonus depreciation means is that in the year that you buy that tractor, you can write off the whole purchase price of the tractor. And I did note that I said purchase price, you can write off the purchase price. You're not limited to writing off how much cash you put into the tractor. So in that example, say you put $0 down to buy this tractor. So no cash out of pocket. You have a $100,000 tractor and a $100,000 loan. You can write that off in the year that you buy it. And your tax savings could be $20,000 or $30,000 on that tractor, but you still didn't have any money out of pocket yet because you're paying it down on a loan. So just make sure you understand that about the bonus depreciation and writing things off. And that second piece I added at the end there is that you can still get a deduction even when the bank technically owns it, or the bank, there's a loan on it and you owe the bank for the full amount. Like that. That's another one of the fun planning opportunities.
Gosh, I didn't even know all that stuff was out there. That's okay.
Yeah.
Okay. You also mentioned in the beginning real estate. So buying residential real estate and commercial real estate as an investment. Like what are some of, I mean, I'm a realtor and an investor and everything. So tell me some of the advantages of that.
Yeah. And Rob, you know me pretty well. We've gotten to know each other a little better. And I haven't brought up real estate much yet. And you might be a little surprised, but I do save, in my opinion, the best for last. I love real estate. It originally started with the tax benefits of real estate. Being a tax guy, I was really drawn to the tax benefits of it. And now I've come to love just every aspect of it, even managing our properties, commercial or residential. I love both parts of it, but the tax benefits of it are just amazing right now. In 2018, they changed the tax laws where earlier I mentioned bonus depreciation. They changed the tax laws to where real estate could also qualify for bonus depreciation. So when you think of real estate investing, like say you're looking at like a single family home that you want to go buy. I want our clients and people to think of like the different components that make up that house. So say it's a $400,000 house and you want to go buy this house, in terms of like interpreting that, breaking it down to what it might mean on your tax return, you got to understand the different components of it. I'm just going to break it down into three basic ones for now. There's the building portion, there's the land portion, and then there's the other assets that are part of that. So building would be like the structure, the foundation, the structure, the roof, kind of the sticks of the building. Land would be the raw land, and the other would be, it's the landscaping, it's the pavement leading up to the property, it's the grass, it's the trees, and then on the inside it's the flooring, it's the paint, it's more of the things that make the house a home, if you will. Yeah. But that last one is what we like to focus on for opportunity, because right now that other property, like those individual components I just broke down, those are all eligible for bonus depreciation right now. So back to the $400,000 example, on that house, or on most houses and most real estate, we're seeing about 30% of the cost of like the purchase price of these houses, about 30% of that usually ends up being this other property. Through a cost segregation, we'd be able to figure out how much that is. So on 400 grand, it's 400 grand times, if I just went straight with 30%, it'd be $120,000. So that now means $120,000 of that property is eligible for bonus depreciation. And what that means, like pulling that all the way through to your tax return, what that means is that you can take a deduction of $120,000 on your tax return in the year that you buy it. So and it's like, say you had a W-2 of $300,000 and you bought this $400,000 property on a loan. That means that your W-2 income, you wouldn't be taxed at the full 300,000. We would reduce it by that bonus depreciation amount of 120 grand. And so now you're only taxed on $180,000 of income. So that, depending on your tax rate, you'd save about 20 to 30% of that bonus depreciation amount. So just make sure with real estate, understand and make sure you know that there's the different components of it. You know, right now in 2022, we have that bonus depreciation aspect to it. And then talk with your tax advisor, make sure So I don't want to just put information out there and promise one thing and then have you let down at the end of the tax year. There are some specific requirements. Like one would be, say if it's an Airbnb property, like, or short-term rental property, there are some specific tax laws with that kind of open up the opportunity for you, where you don't need to spend as much time in real estate, like in the real estate industry as a whole, to qualify for those deductions. Because think of like an Airbnb property, is you're more like operating a business, like you got people in and out of there every week, compared to a long-term property. Say you've got people on a 2-year lease. That type of property, you'd just be collecting rent checks, ideally once a month, and that's a passive activity. So there's passive activities like long-term rentals, and more of the active type of rental real estate, like an Airbnb property. There's very different tax laws and like limitations on how much you can write off in those. But if you're like Rob, if you're a realtor, if you're actively involved in real estate already, even the long-term rentals, like those more passive investments, it would open up the opportunity for you to write off those losses and offset your other income. But any questions on that, or anything that's not clear on that, Rob, or you think I should kind of go into more depth on?
No, I love it, and it's amazing how much real estate can open up and the opportunity. I mean, there's the appreciation, there's the depreciation, there's improvements you can do.
Yeah.
And, even as a non-real estate agent, I look up and I'm like, it's one of the best investment strategies out there. It's my number one. I love it.